Hello, everyone, and welcome to the weekly Q&A with Environmental Trading Edge. We are going to go over a couple questions, and if you were with me on my earlier stream, you realized that I had some technical difficulties, so we should have some good solid sound now. Anyways, the questions that we've got today are going to be going over the price action in the S&P today and kind of what happened in the markets and why it kind of creates it. And then we're also going to go through what is XSP, how it kind of relates to the S&P 500, and those options for trading like smaller type of counts, because I get a lot of questions about XSP, and we'll go through that. So that's always something that is asked quite often, and then we'll go through some of the macros that are going on and what's going on as far as this recession and how that's kind of interplaying into everything and what it's likely to kind of create. And so without further ado, we'll dig right into oh, by the way, if you have any questions or anything like that, just throw it in the comments. I'll see them. I'll check back on the screen as I'm kind of going along, and I'll be able to answer any questions that you have live also. So that's always something that we do in these weekly Q&As. Like I said, I hold them typically around 3:30 every Wednesday. And anytime you see me go live, you can, of course, always interrupt, ask some questions, things like that. And I can dig into anything that you want, basically ad hoc. All right, so let's dig into what happened in markets today. So this is basically called like it's an intraday short squeeze. So you've got daily short squeezes and intraday short squeezes, but basically like what is a short squeeze? So let's look at the market today, and you can see that in general, you see that we have this big, downtrending, and then all of a sudden right here, it just goes and it explodes to the upside. So what happens right here? Why does the market have these kind of price actions? Well, that is because what happens is let's just like play this out as like an intraday short seller. So let's say I open a position, so right here, and I'm -1, so I'm a short seller. So what I do is I sell a share. I borrow a share so that I sell, right? And so I sell a share. And so if the market goes down, I make money. And if the market goes up, I lose money, right? That's the position that we have. And typically short sellers will put some sort of stop behind the market. So let's just put our stop back here. And as the market kind of goes down, right? And it goes down, right? We'll move our stop down. So here we had it up here. Now we're going to move our stop right here. And I'll make this a different color so that we know kind of where it is. It'll be red. So as the market kind of goes down, it goes further. I'll move my stop down. Moves further. I'll move my stop down. Pushes down further. I'll move my stop down. Pushes down further. I'll move my stop down, right? So now my stop is right here. So then what ends up happening is as the market stops going down, and the reason it stops going down is because, think about the market as like a living organism. It kind of has to breathe a little bit, right? So as it exhales and it exhales to the downside, it has to kind of draw in a breath. And so it's got to take these like, momentary blips of price action, kind of relaxation, right? And sometimes that if the selling pressure doesn't consistently stay there all day, then what ends up happening is you have just a little bit of a strength in a very trendy day, and it comes up and it basically snags this short order or this short stop right here. And this short stop is actually a buy order. So that's what happens when we sell a share to begin with. In order to close the position, we have to buy it back. This is why short squeezes, or in bear markets or in bearish moves, this is why that massive rally, those huge spikes from the bottom, those huge days, right? Some of the largest up days are during bear markets. And this is why, right? It gets, it's this big short squeeze that gets blown out, and you have to buy back your share. Well, then that buying pressure pushes the price up even more, which hits more stops, which pushes the price up more because they're closing out their positions, right? And then it blows it out more and more and more, and it's hitting all these stops until eventually it kind of runs out of stops, right? There's, it basically blew out everyone kind of intraday here with all their stops. And then it's just kind of fizzles, right? And then then typical price action is that the market will like to see if the rally has legs, right? And by having legs, what I mean is there actual buying pressure, or was it a short squeeze? And that's when you'll see if this next rally holds up, right? And if it holds up in its next pullback and we get a big push up and the day is able to push out positive, that is a good sign for the bulls, because that would mean that the rally had legs. That means that it probably signified a very substantial bottom in the market. That is not what we got today. So we did not get a leg or a rally with legs. We got further weakness into the closed and ended up actually posting a negative on the day. Now, because we posted a negative on the day, that typically does not bode well for the bulls, but it is really good for the bears, right? So likely we are getting near a short-term bottom, or at least where the market's going to slow down just a little bit. But it's so hard to tell off of just one day price action. Plus, we've got a massive macroeconomic headwind. We'll talk about that here in just a little while too. But basically, I wouldn't be betting on the long side except for some sort of short-term bounce type of thing right now. Thanks for letting me know that there's better with sound. Yeah, that was pretty bad. I literally just did this recording live I was probably on there for a good 30 minutes. And then, I just realized on the comments that I didn't have sound. So anyways, we fixed it. So, anyways, going back to this, we are yeah. Okay. So anyways, that's why we have this kind of price action the way that it did today. Like I said, it doesn't really bode well for anything going on. Now, something I'm going to talk about is, what else is kind of making me, a little bit more convicted with saying that the market's going to continue down. Now, I drew this a little bit earlier in our previous, recording that I didn't have sound, but, we'll still kind of, get the gist of it here. So in general, this blue line here, this market, this was how I was kind of planning out our recession. I was pretty confident, actually, that this is how the recession was going to play out. And so I was prepared for that. I set up my portfolio for that and everything. And I had to make a little bit of an adjustment right here. I actually pushed some of my long portfolio long right here, but I was still fighting it with some of my options trades. So any of you guys that follow like my Adapt Advance, you know that I had a little bit of a challenge on my options trades through this, but my portfolio actually had a nice little time through this. But the point is that going through here, as we should have gotten to this quarter, which is where we're at right now, and we should have started to kind of react to the contracting growth that's going to happen during Q4 of 2023, Q1, and Q2 of 2024. So that should have pushed this guy all the way down to about here, which should have been about a 35-40% retracement or so on the market, got us to pre-COVID levels, or like back when the not quantitative easings kind of showed up in 2019. And that was a pretty good target kind of guesstimate for how things were going to kind of play out. What the Fed ended up doing is during these printing process right here in this quantitative easing, they stored a bunch of money in what's called the reverse repo market. And that reverse repo market started to drain into the market. And when it does that, it's very stimulative for risk assets. I know I've talked about this more previously, but basically what that does is it means that there's a buyer back here willing to push prices up. And so back here, you can see that we kind of launched higher. So what this orange line is saying is kind of the new kind of playing out now that we're adjusting for the fact that that reverse repo market, that market manipulation was kind of in play. This is more likely how it's going to kind of play out, right? And we should probably bottom out around 341 or so-ish this is on SPY. That should give us a total retracement from this high down, probably about another 27% down or so is probably more likely what we have in the downtime. Our worst quarter is probably going to be this quarter. That's at least my projection. Not saying that it's going to, but this should be the hardest quarter. And then second quarter of next year, that's when we should see a little bit more stability and things like that. So we should kind of melt down or kind of roll over. And I don't know if it'll be as choppy as this first section back here, but it should be relatively precipitous to the downside. That is how we're looking as far as my projections go. So let's kind of look into why the market's kind of melting down so fast right now, besides the fact of what I've been talking about, and it's the reverse repo market. And so if I jump over to, if I jump over to, here we go. There we go. If I jump over to the reverse repo, right? Then what we can see, so here back in is green is the reverse repo market back here. And you can see this is pretty clear as day, right? That right around here where I said the market should have kind of stabilized for a little while before it started rolling over, we got this kind of balloon up to the upside. And that's because this reverse repo market started to drain into the treasury market. And then when it stops, of course, the market rolls over, right? And then as soon as it starts up again, the market tries to go up. And then as soon as it stops again, which it just did, right, just a few days ago, the market just starts to melt down. But there's a lot more selling pressure now than there was even back here. So definitely to the downside, we can definitely keep pushing down. And it just depends on if there's enough demand for bonds. If there's a lot of demand for bonds, what will actually end up happening is that all that demand for treasuries and bonds will end up pushing the front end of the yield curve down and make it to where this reverse repo market won't actually drain into the market, and it'll create more selling pressure on risk assets. So hopefully I kind of explained that relatively well. I know that's kind of a complex topic, but basically, if we see the reverse repo market going up, or if the Fed doesn't change their quantitative easing / tightening policy, or then likely we're going to see the selling pressure continue, and they're popping the bubble is basically what they're doing. And they created a little bit of a bubble right here. So normally, price action wise, we should check back in where the bubble started. So this would be a very natural position to go to, which, on the S&P 500, I think that's here. We'll turn this into. On the S&P 500, that should be 4150, 4180 or something like that. That would be normal, wouldn't even be a shock, and that should be kind of relatively normal, somewhere around here. So that's how that's concerned. All right, so now to talk about XSP. Oh wait, no, we'll talk about XSP. So XSP is one of those. Here, we'll pull it up actually. So we'll go to XSP. So XSP is mini SPX options index. Now, what's nice about the XSP is that they're 1256 contracts. Remember that none of this is for financial advice or anything like that. Read our disclaimer. But XSP is 1256 contracts, so you do get the nice 60/40 rule for your tax benefits. If you're using a taxable account. So that's always kind of nice. Now, the only issue that I've had with the XSP is that what ends up happening is when you put in an option, they kind of automatically go to the natural instead of the kind of the mid price, or you'll end up getting pushed around on your prices. There is enough liquidity in XSP that I've seen, right? I've definitely pushed in some orders just to kind of test it out, and it's there, but it's natural pricing in even if you go into like Thinkorswim, right? Its natural pricing is way, way off the mark of where those options will actually fill at. So unlike the S&P, when you typically, or the SPX, when you typically just throw in an order at mid, you're relatively close to where it's going to fill. You're normally not too far off. Now, of course, you want to kind of play with it a little bit, especially if you're trading with some size, especially if you're over anything over like 1 million. You definitely want to do something. But what ends up happening is The XSP does not play like that. Like I said, they start you off, even if you try to throw it in at its natural, just throw in your order, it won't necessarily start you off right at mid. It'll start you pretty far off. So you got to work it to the market. So that's one thing that I'd say just to kind of watch out for. That's happened to a couple of my members, and they've definitely let me know about it, that if you just kind of throw in an order, even like just a single call order, it'll be way off, and you'll end up becoming relatively angry about about what you end up getting filled at, because you'll start off your trade at like per call being down like $150 per call, and that's never a lot of fun, right? Especially in the XSP when you're probably trading smaller anyways. So that $150 per call is that's a big deal, right? Then the other question that I got is more in line with our strategies, right? And so the what's going on with the daily strategy, what's going on with the Adapt Advanced strategy. So let me just kind of move over there. Okay, so typically during volatility, this is why I get asked this a lot, is typically during high volatility or crazy times, everyone's looking for something that's relatively working well, and that's what's great about definitely the Adapt Advanced and then the Adapt Dailies. Both perform very well during these types of environments. And so if you look here, the Adapt Dailies have actually taken over the lead. We're up about almost 73% for the year as of right now. And that is after a very trying time. So we'll talk about that as we kind of roll down here. This is a chart. Now, keep in mind, these are my personal trades, right? So these are the returns from my personal trades and the P&Ls per trade on here, right? Now, I don't have it scaled to my account size, but what I did is I just have it to where those profit and losses, take out commissions. This is basically how it's performed. So you can see here, I had a good beginning of the year, and then all of a sudden, a few months ago, we ended up having a really trying time. Now, I drew this line down here to kind of show what the general loss or like the general drawdown that's to be expected. And so I anchor more on this line down here in my head of basically knowing what I've locked in, right? And you can see that as we're pushing into new high waters right now, I kind of locked this in, right? And this is how much, so drawing down to here, while it might not be fun, it's just noise, right? That's part of the strategy. It's part of its statistics that it's possible that it can draw down like that. And it's even possible to surpass it a little bit. But I really don't even worry about things until we kind of hit it or surpass it. Then I'm like, oh, hey, there might be something going on here. Anyways, I digress. So pretty much right when we got to that point, our maximum historical drawdown, we've basically just pumped up from there. And it's really been a great time. So been a lot of fun going through this. As the volatility's kicked up, we've done even better. Really, everything's great. This was actually during that time of the reverse repo market kind of draining and artificially pushing the stock up and things not being very natural in the market. It was very unnatural for the market to behave like that. So that there's no wonder why my strategies kind of had a little bit of a trouble, just because that was some market manipulation rather than traditional market behavior. We do tune for some adjustments in the environment and stuff like that, but to a certain extent, if the Fed comes in and dumps $1.5 trillion into the market, into the bond market, which then translates into leverage into risk assets, it's basically like pouring gasoline on a fire. It's crazy how much it can do. But anyways, then the Adapt Advanced, I actually had a trying time going into that same time period where the reverse repo market was being drained as well. And then now we're doing pretty good too. So the dailies can actually keep up or outperform me on my Adapt Advanced. But instead of it being more of like, as some people would kind of think of it or like say it's kind of like a black box. But the black box, it's not a black box because it kind of mutates and changes with the markets, and it adapts itself, hence the names, right? And then the Adapt Advanced is more of like a human driving a black box type of thing. So you kind of have a metric that you kind of follow along, and you kind of know what the risk is in the market. You know what structures are in favor and those types of things, and you make sure you're in the right structure, and you know what kind of risk is living in the market. And so that's why we can manage our risk really well. And so that's what the Adapt Advanced does. And so we'll see where we finish out for the year, but we've had really, about 20% months in a row, so it's been pretty nice. So that's where the strategies are at. So I should have knocked out the XSP questions, knocked out what's our strategies doing question, and then what kind of went on in the markets, touched on macros, and that should wrap us up for the day. And that is pretty much all I've got for the week. And I will see you guys next week at 3:30 Pacific time on Wednesday. All right, have a great week. I'll see you next time.